Good morning, Timeline. How are we?
Good morning. We're very well. How are you?
I'm very, very good. Very good indeed. I am super excited for this session, guys. I think it's going to be really, really good. We've got plenty of people entering the room already. Good morning, Amanda. As always, everybody who's joining, thank you for joining us. I usually give it 60 seconds to 2 minutes to let everybody get in and get themselves settled. But as always, all of the functions are available in today's webinar. So if you've got any questions, feel free to drop a message at any time, and I'll stop the amazing Georgios and ask him some questions. And Kate's here to pitch in and help as well. So any questions at any time, please make the most of the time that you have today with Timeline. If you've got any questions at all, please fire away. I've got Amanda and Jade in the room today, so they'll be helping, giving an extra hand on any sort of links or any sort of content that you need to be aware of as well. So I'll just give it another minute whilst we get a few more attendees join us. And I've got a bit of a webinar gap now, which is quite nice. I've got a few weeks where you're not going to see me on a Friday morning, and we're going to start gearing up for our next series of content, which is going to be absolutely incredible as well. So expect more from Timeline as well. We've got a few things in the diary as well, haven't we, Kate?
We have. Looking forward to it. It's going to be absolutely a great spring.
It really, really is. It really is. So I will get started with today's webinar, if that's okay. So as always, the session will run for about 45 to 50 minutes. As I've already mentioned, everything is available for you to use. We are going to be running some polls as well. So please do participate in the polls that we run. We will share the results of those polls as well. So let's try and keep it as interactive as we can. Any questions at any time, please fire away and we will get them answered for you. So I just want to touch briefly on the Financial Planning Club, who we are and what we're up to. So we provide one-to-one bespoke business consultancy for financial planning business owners. Everything we do right now impacts our results in the next 3 to 6 months. So we are either crafting bespoke 3-year plans, we're updating your current 3-year business plans, we're breaking them down into 12-month roadmaps, again into smaller 90-day sprints, holding you accountable, holding us accountable. Everything that we do has to be steering the ship towards our business plans and our goals. So whether we're running bespoke workshops or giving you the ultimate BD blueprint, we look at every single aspect of your business. The true saying is, if you don't know where you're going, you'll probably end up somewhere else. All right. So it's very important that you've got clear plans in place for your business. You can test this. So we have a fantastic scorecard, and at the end of the webinar, you'll get an email sent from us that will have the recording of today's webinar as well, but it'll also have this scorecard. So if you want to participate and rate your business, there's 4 areas that we will support you in. You'll also get a personalized email from Amanda, just with some recommendations as to how we can step in and help your business. Touching briefly on what we got coming up, we have the power of influence. So there's a chance for you to come and spend a day with us. We're in London. It's Thursday, the 8th of May. It is exclusive for business owners only. We've got about 10 seats left. So we are talking about personal and intergenerational motivators. There are going to be some really good interactive breakout sessions there. We've got Dimensional coming in and doing a really, really cool session on client referrals. And what we are actually doing, we are building the ultimate client referral machine. So once we know the motivators and we know how to really get client referrals working for the best for our business, it's putting everything together. It's working collaboratively with the 60 other owner managers that we're going to have in the room. It's going to be an absolutely epic day. So we've got about 10 seats left, and we'll give you the chance to come and hang out with us for the day. That'd be really, really good. As always, you know about the club now, hopefully, but if not, come and hang out with us in our WhatsApp groups. We've got specialized WhatsApp groups for financial advisors, mortgage advisors, power planners, ops managers, all separate groups, all keeping the conversations relevant. It is there to help push new ideas, peer-to-peer, collaborative exercises. If you've got a question, if you're stuck on something in particular, somebody has been there and done it, navigated those challenges. They're in our WhatsApp groups, they're in our communities. Please come and have a look at those. Study groups, discounts. You're on our webinar today. We've got a podcast series out as well. I think we're about 40, 50 episodes deep. on our podcast series as well, and that is purely business owners. So if you're doing a lot of commuting and you want to listen to some podcasts, Spotify and Apple Music, wherever they all are these days, but our podcasts are over there as well. If we look at our amazing collaborators, our strategic partners, our educational providers, technology solutions, compliance support, recruitment, everything in between, we are working with some amazing firms at the moment, and it's all about driving innovation and new ideas to the industry that we all know, love, and work in, and that's financial planning. So please feel free to check out any of our collaborators as well. And now the floor is yours. Georgios is here today to talk about assumption-based versus evidence-based. He's the man. He's got all the ideas. He's very switched on, very alert and ready for today's session. So if you've got any questions, look, you're not going to have a better time than you have right now. So please, Georgios, thank you very much for joining us today. I've heard you've got a very relaxed approach. I was on the video at 9:45 waiting for you. You rock up 1 minute before. You've got it. It's in the bag, and it's how you do things, right?
Thank you, Lee, for a start. Thank you for having us. Really excited to be here. I'm going to go ahead and share my screen.
Fantastic. I'll stop sharing mine.
Right. 1 second.
Just whilst Georgios is getting the slides up, just wanted to make sure, Lee, just to echo your comments around everybody that's joined us today. Please make this session as fluid as possible. Georgios would love any questions as we go through this. We'd love to share your experiences, your views, how you see the world. So please do jump in with any questions. I'll monitor the chat, Georgios, but please feel free, if that's allowable, Lee, come off mute, ask questions and be interactive as possible.
Absolutely.
Perfect. Hi, everyone. Just a couple of few things about myself before we even go to this. For all the people in the call who don't know me, in other words, everybody in this call, I work as a senior quantitative analyst in Timeline. We're a leading DFM and technology provider. I came to the UK about 10 years ago. I couldn't speak a single word in English. Here we are 10 years later. You guessed it right. I still cannot speak a single word in English. But in the meantime, we build our own, as part of our ecosystem, we build our own cash flow modeling tool, which has been used to produce over 60,000 financial plans. So today we will be discussing about different approaches into cash flow modeling and how we can use them effectively when we do the planning. So with that, Lee, I would be very happy if we can push the first question up.
Absolutely. So this is the approach. So the cash flow modeling approach. There's a poll that's just come up. So which cash flow modeling approach do you typically use? Assumption-based, evidence-based, stochastic, and combination. So please feel free to participate. Let's see where would you expect it to be, Georgios? What do you where do you see the audience these days?
I would hope for combinations, but I expect that we'll see assumption-based dominating this poll.
Really? Okay, interesting.
Yes.
Interesting. So we've still got a few people left to participate, but we've had a lot of people, over 60% of people, put their vote down.
We have one person who is using stochastic. Shout out to that person. One person. Brilliant.
There we go. 70%. So there. So I will last 5 seconds. End the poll there. We'll share the results amongst everybody. So you're pretty much right. Yeah. So it's assumption based and combinations. Yeah.
That's what I would assume. Yeah. So there is no right answer to this. My view is that it's a combination of all these approaches, and hopefully by the end of this presentation, I can point out the reasons why we should be using all three approaches. So with that, I'm going to continue with the presentation.
Perfect.
Okay, so the agenda for today is we will define each of these approaches, very high level, and then we will see the strengths and the limitations of each one of them, and finally how they can be used in planning. We'll start with assumption-based. On the bottom right of the screen, you see a hand in the air, which suggests the obvious. When we work with assumption-based approach, we need assumptions. We need assumptions for the expected growth for the return, the inflation, the interest rates, and many other variables. We need to decide the period for which the investment period for the planning that these assumptions will apply. And are we going to use the same set of periods for the whole period? That would be straight line projection. Or do we want to create bespoke assumptions for the latter part of the investment planning? Let's say the last 10 years when somebody's in their late 70s, 80s in retirement. And finally, clarity. By clarity here, we need to make sure that the assumptions are aligning with the client's risk profile, they're accurate, we need to be able to justify them, and we need to update them periodically as well. With that, let's look at a very simple example of a straight line projection. We have John Doe, £100,000, £15,000 spending, and £10,000 income, both inflation adjusted. And after having spoken about how important it is to have justifiable assumptions, I'm going to go ahead and use 5% inflation and 10% return for no obvious reason. What we see here is all the possible outcomes of this analysis, which is one, because we're doing straight line projection, we only have one estimate for return and one assumption for inflation and return. The benefit with this approach is that we're using a fixed set of assumptions, and therefore at any given year, we can precisely compute what the balance would have been, how the impact of compounding feeds in, what the withdrawal is in real terms. We can compute everything precisely. And the reason for this is because there is no uncertainty. It's really easy to get our hands into it and understand the investment portfolio, the cash flow. In this example, we'll see the red bars represent the spending, the blue bars the withdrawals, and the green bars annual income. This is a straight line because we're looking at it in real terms. But at any given time, we can precisely see the values and be able to measure them and explain why they are what they are. And this is because there is no uncertainty involved. We work with a very fixed set of assumptions. This is it about cash flow model, about straight line projection. There is not my favorite, so I'm not going to go really deep into it. It's really simple and straightforward to explain. Just make a couple of assumptions, and then we produce a single outcome of chance. It's not chance. It's easy to explain to the clients and works well with predictable variables. That is to say, when we really know what the expected rate will be. On the other hand, it completely ignores uncertainty. It provides false precision because it's simple to understand. It has zero connection with reality. That doesn't mean it provides an accurate picture of what is going to happen. It doesn't take into account sequences of returns risk, which is fundamental when we do planning, both for people in decumulation and accumulation. And all in all, overall, this approach is not suitable for planning. However, we're not going to throw this approach away. We will be using it in several different stages with conversations with clients, but we will see when later on and how. So for now, I'm just going to stop there with assumption-based and move on with stochastic modeling. And we see a very confused person on the bottom right, probably rightfully. If we see the poll, only one person voted that they use stochastic modeling, so that means something. I want to pause before we go into this. There is a general misconception that stochastic modeling can be used in anyone's benefit. You can manipulate it, you can show whatever you want. It's a random simulator. I hope to break this because this is not the case. It can happen, of course, but if done correctly, the stochastic modeling approach should provide very precise results, and we will see how. It's not a random simulator completely. It shouldn't be used to manipulate numbers or provide the picture that we want to see. So let's give a definition on stochastic, and a definition that we can understand intuitively instead of a mathematical one. By stochastic, we mean a process. This is to say an equation that uses probability to model uncertainty. Remember how when we talked about the assumption-based approach, we said we need assumptions. Well, with stochastic modeling, we need more assumptions. I never really understood why we call the assumptions approach the straight line projection assumption-based, and we do not call stochastic modeling more assumption-based. There are literally so many assumptions in this approach, but we will dive into it. You have the same capital market assumptions. You need an expected rate of return and volatility, interests, and anything else that you would fit in typically even in a straight line projection simulation. But then on the heart of you need the model. This would be the equation, the mathematical model that would be responsible for simulating the asset prices or the inflation or the return. And there are different models. Some of them are continuous, some of them are discontinuous. They take into account big jumps. They can model big drawdowns like COVID, pandemic, bear market scenarios. There are different models in the literature. Once we agree on the model, we have the method. The method takes into account the model to produce a very large number of scenarios in order to do the analysis. And for that, we need technology. We need computational power because we will be running a very large number of scenarios. And finally, we need clarity. The issue with this approach is because we are working with random scenarios, it's difficult to conclude on a result because you cannot rely on individual scenarios. You have to rely to the whole spectrum of simulated scenarios, 1,000, 10,000, 100,000 scenarios. So for that, we need key statistics, key metrics that apply to the whole range. And let's look at an example of a model. This is just one model, the most famous one. All practitioners use it, geometric Brownian motion. Brownian motion itself was invented by Brown and then later on studied by Einstein. It has nothing to do with finance. It's a physics concept. And then in the 1950s, it was introduced in finance for the first time. But it was only until 1973 that it was used within Black-Scholes option price formula that won a Nobel Prize, in fact. The assumption for this model is the asset prices are log normally distributed. The inputs are an expected rate of return and volatility that are constant across the whole investment period. They do not change. And finally, we need a process, which is called the Wiener process or Brownian motion, which is responsible to produce the randomness. This is the shocks in the price movement. And here are the mathematics behind the model. So far, all we've seen is assumptions, a model, a method, mathematics, and personally, I have no idea how to use this. How do I communicate this or what that means? Or which portion of that should I explain to the client and how? And I completely agree. So let's start with something really intuitive. Let's start with a straight line projection. Let's assume that the expected rate of return is 10% as an example. What we're going to do is we're going to also assume a standard deviation, volatility of 5%. What that does is it creates an expected range of returns. So instead of the performance being every year 10%, we've now created an expected range of returns, one deviation away from the average, so from 5 to 15%. And we can go a step further and look at 2 deviations away from the average. So in this example, 0 to 20%. What the model does is it produces random returns, unique sequences of returns within the expected range of returns that we have created based on the capital market assumptions. You give me a drift, that is to say the expected return, you give me a volatility, and the model will produce random, unique sequences of returns within this expected range. Of course, there will be returns outside the 2 deviations, the outliers. And below, you see the numbers that are the probabilities that these returns will be produced. In other words, you have a 68% probability that the return that will be produced will be 1 deviation away from the average. Now that we understand intuitively what the model does, let's do an example. We're going to simulate £100,000 using a 10% annual return and 15% volatility for 10 years. This is one scenario. We can see the final value by year 10 was £400,000. Now we're going to simulate another scenario. what I observe here is the sequences of returns are completely random and different from one scenario to the other. And even the value of the portfolio at year 10 in the second scenario is completely different, not even half of the value of the first scenario. And let's do another scenario. Again, completely random, completely different sequences of returns. So then the question is, we understood the model, we understand what it does, we can use it to do simulations, but what have we learned from that so far? The answer is nothing. Because to learn from that, we need the method. The method, the so-called Monte Carlo method, is responsible for the analysis. The way I like to think about it is as a funnel. What comes inside the funnel is the model itself. In our example, geometric Brownian motion model. And within the funnel, we produce a very large number of simulations, 10,000, 100,000 scenarios. But outside the funnel, there should be only one output, which is statistics, key metrics that take into account the whole variability, the whole spectrum of simulated scenarios. Let's look at an example. We're back to the £100,000 initial investment, 10% annual return, 15% volatility. Here I have assumed a 4% withdrawal per year. That's not inflation adjusted. That depends on the initial value. It will be the same amount every year. And we're going to look at this plan for 10 years. Here I need to define success. I need one metric that will take into account all of the scenarios. Usually you would expect the success to be the probability that the portfolio will not run out of money, or the probability that there will be some legacy amount left. In this example, I've just assumed that a successful scenario will be a scenario that the value of it by year 10 is greater than £150,000 on the basis that we start with £100,000. The first chart shows you 10 scenarios, the final value at year 10 for 10 scenarios. You can see, for example, there are 10 bars, one for each scenario, and you can see that 9 out of those 10 scenarios, the value of the portfolio has been greater than £150,000. And therefore, the success rate is 90%. 9 out of 10 scenarios have been successful. Okay. Is this good enough? Can I communicate this to the client? Do I feel confident that this is a robust analysis? I'm going to do 100 scenarios. And the success rate dropped from 90% to 78%, which is a very significant drop. And in fact, we see way more variability now. There are more extreme scenarios have been included in the analysis. I'll go a step further and do it with 1,000 scenarios. The success rate drops even further from 78% to 71.8%. But now we start to see a pattern, a distribution appearing. And then I can go one more step at 10,000 simulations. And now we see that the success rate only changed by 0.3%, very minimal change. And the distribution becomes even finer. So a robust Monte Carlo analysis is one where the metric converges. It doesn't matter that it is a random simulator. It doesn't matter that it is stochastic. The key metrics that you're analyzing, the probability that your client will have a sustainable plan, the probability that the portfolio will not run, will have a legacy amount, should have the same number if you were to repeat the experiment over and over and over again. The metric should converge. This is the key point that makes a Monte Carlo method robust. With that, we can move on to a quick review of stochastic modeling. Good stuff captures uncertainty. It produces a very big range of outcomes. It can be used for what-if analysis. What happens if we set the volatility to 0%, for example? Then we're back to straight line projection. What happens if we increase the expected rate of return? And the method is flexible to the model. I can choose whatever model I feel suits better the analysis I'm doing instead of geometric Brownian motion. But the method that itself, Monte Carlo, it's flexible to the model. On the other hand, there are too many assumptions, capital market assumptions, the model assumption, and it's really complex to understand and complex to explain in some extent. And it requires a lot of computational power. But the most fundamental criticism of this approach is that it is only good as the inputs. Even if the mathematics are correct, even if the computational power is good enough, if we are providing unrealistic assumptions for the asset classes, the results will also be unrealistic. So it really depends on the inputs. So with that, I think I'm going to Lee. Are there any questions or any comments so far? If not, I can continue with the evidence-based approach.
Yeah,
Georgia.
yeah, go on, Kate. No, Kate, go on. Over to you.
Well, I was just going to, there is a question in the chat from
Yeah.
Mike, which we'll come to in a second. I just wanted to kind of take a moment to pause, because I think for lots of people on this call, you know, this is kind of really taking a deep dive into cash flow modeling and how we think about the world. And I think that what it's fair to say in summary, if you agree, is it's really kind of to showcase that actually, you know, you've got cash flow modeling, which is brilliant, and actually kind of your standard linear assumptions are really not taking into consideration the number of variables that I think good cash flow planning considers when it's really looking at how the client is going to fare over various different kind of economic crisis, but also their retirement phase, their longevity, and what they're looking to achieve. And I think that as we walk through this, what's becoming apparent is actually there's a huge amount that goes into the engine that kind of when we're looking at that scenario planning. Is that a fair assumption, Georgios?
It is, Kate, yes.
Perfect. Can you see Mike's question, or would you like me to?
I can actually, and I think it's a brilliant question.
I do too.
The question is, I'll read it out loud. How do we know which scenario to use with a client?
Yep.
If you have 1,000 scenarios, it's all guessworks. Which one should we use? And that's brilliant, all of them. The answer is when you measure if the plan is sustainable or not, you need to take into account all of the scenarios. When it comes down to demonstrating cash flow balance, you need to pick a scenario, because you cannot obviously demonstrate the cash flow chart for 1,000 scenarios. There are the common practices. You can either go with an average median approach, or you can use the worst case scenario to demonstrate the cash flow. But to give you some context here, we are worried about there's like 1,000 scenarios, which one to use. And yet with straight line projection, you're showing a scenario that didn't even exist. We just assume 5% return or 10% return. And then we rely on the cash flow modeling on that, and somehow we feel more confident, but that never existed. It's just a demonstration. So you can, on that basis, you can do the same on worst case scenario. But please let me elaborate more on that once I go to the evidence-based approach, because this is where it becomes really meaningful, because you're working with real data. So I'll stop there and then we can.
Absolutely. And I think it's fair to say on that point, Georgios, just for everyone's clarity on the call, this is not, by the way, us sitting here saying, let's use those maths equations in front of clients and let's walk through this. This is kind of providing that backbone, that structure to how you are reaching the conclusion you're reaching with a client, and therefore being able to use such a powerful tool or certain cash flow planning, whatever that may look like for you and your firm, to provide a client with an outcome that you know is fact-based, it's been robustly tested, and this is the way that we then provide that in a really simple way for the client to understand when we talk about scenarios and how many of those scenarios have been stress tested, which Georgios is going to go on to. So this is just kind of giving you the backstory and putting the meat on the bones around what we should think about when we're looking at cash flow tools, and what do we actually want to do to make sure that we know that all of our good financial planning work has been plugged in. Sorry, Georgios.
Yeah, there are two more questions, but I'd like to keep them for when we do the evidence-based approach first, and then we can. Okay. All right. So with that, let's move on with the evidence-based approach. As the name suggests, data. So this report, we're not going to go really deep into it, shows the growth of wealth for major asset classes, global equities, emerging markets, several others for over 100 years, percentage of positive, negative returns, high, low return, impact of political parties into UK markets in the long run, not very big, bull and bear markets for UK equity, and many others. So the idea is we will use all of this evidence to stress test the sustainability of a financial plan without making any assumptions. But before we do that, let's look at a very simple example. What we see here is the recovery period for its bear market for UK equities since 1926. Had we invested exactly £100,000 at the beginning of its bear market, it shows you how much time it would take for the portfolio for UK equities to recover back to £100,000. It shows you the maximum drawdown and then how many the recovery period. For example, the latest bear market, which was during COVID, it was in fact the second fastest bear market in terms of recovery since 1926. So we can already get a sense of all these unfavorable sequences of returns that you can imagine that if the client was subjected to them early on in accumulation, it would completely throw the plan off, and we would have to make several adjustments to make it sustainable. So it's quite clear the importance of sequences of returns. Let's create a setup. What do we need to work with evidence-based? For a start, we need real indices. This is historical indices that go back in time that we can use as proxies for asset classes. Then we need fund mapping process. The portfolio holdings didn't exist back then. So what we need to do is we need to map the funds to historical indices as accurately as we can. And then we are going to stress test the mapped version of the portfolio. We need computational power because we will be running thousands of rolling scenarios, same as we did with stochastic modeling. And finally, we need clarity because, again, we have so many scenarios. Here, it's a little bit more meaningful because the scenarios are actual scenarios or observed sequences of returns. So working with particular scenarios, it's possible. They are not random. But still, we need to take into account the whole range of scenarios. Let's look at an example. We have John Doe, £1 million invested into a 50-50 UK equity bond portfolio, £55,000 per year spending, and £10,000 income, both of them inflation adjusted. We're going to make no assumptions. Instead, we will take the financial plan, put it in a time capsule, take that, and go back to all the possible market events, including world wars, recessions, double-digit inflations since 1900, and look at all the 30-year scenarios and use the sequences of returns of its 30-year scenario. We're going to use consumer price index for that for its 30-year scenario as well. Zero assumption. We will rely on the sequences of returns of its scenario. And this is what the first chart shows. This is the value of the investment portfolio. The red line is the worst case historical scenario. In this example, it started in 1974. We're doing 30-year scenarios in this example. The green line is the best scenario. And then all the other lines are also 30-year scenarios from 1915 to 2023. I mean, within this very big period. And if we look at it for a second, we see that by age 80, in worst case scenario, the plan would have run, the plan would not have been sustainable. The portfolio would have run out of money. And instead, it's not just the worst case scenario, but it's a couple of other scenarios we can see there that the plan would have run out of money. So this initiates a conversation, which is, which scenarios are those? How comfortable is the client with those scenarios? How extreme scenarios are those? Is it a world war scenario? Is the client comfortable to the idea that the plan may not be sustainable if we go through another world war, which it's probably in our door, no one knows? Or do we need to make adjustments to the plan to make it sustainable even in worst case scenario? But even if we do that, if we create a plan that it is sustainable in worst case scenario, this will lead to a situation where for all the other scenarios that the returns have been favorable, the client will end up underspending. So then we may need to establish a rule-based approach to withdrawals, where it utilizes, if the sequences of returns have been positive, favorable, we can increase the withdrawal rate, or if they have not been favorable, we can retain a smaller withdrawal rate. There is a big literature around spending rules with guardrails, guidon, and so on and so forth, on how we can take a rule-based approach that utilizes sequences of returns. And of course, we can see the same with a cash flow chart. This is the same worst case scenario. coming back to that question, which scenario should I show? Here, I'm showing the worst case scenario, and we can see that by age 79, same as we see in the ballast chart, the portfolio ran out of money, and John Doe needs to either die earlier, which we don't want, or make changes to the plan to make it sustainable until age 90. Finally, this picture shows the sustainable spending. It takes into account all 30-year rolling scenarios from 1915 and computes what is the annual inflation-adjusted spending amount that the client could sustain for the portfolio to run out of money exactly after 30 years. In other words, what is the spending that historically would create a 100% sustainable plan by taking into account all possible historical scenarios. Quick review of this approach. It uses real historical data. It captures sequences of returns. It produces a very large range of outcomes. It's ultra tractable in the sense that we can, same with the assumption-based approach. It's intuitive, we can understand it. We can compute what numbers, we can see the assumptions and what numbers have been used, and it's very easy to explain. But there is one fundamental criticism with this approach, which is that past performance is not an indication of future performance. And therefore, should we really rely our cash flow modeling on completely on historical data? Since these sequences of returns, they're not going to repeat themselves in that order, at least. So how do we cope with that? I'm going to go ahead. Actually, I think I'm going to pause before we go to the evaluation, if there is yet maybe any other questions at this point.
There's some in the chat, Georgios. Becky's asked the very question you've just ended on, which is about past performance is not a measure of future performance. So how can we rely on it? So it's Becky, I don't know if you had a sneak peek at the slides before this call to know that that was the ending line, but maybe we could dive into that, Georgios. And I think Mike's had another one about which cash flow tool predicted Trump.
Sorry, let me read the one about okay, yeah, change of plans. I'm gonna go ahead and we can do all questions at the end, if that's better, Lee. Yes?
Yeah, it's fine. Yeah,
okay.
It's fine.
Right, so bear with me 1 second. Right. So what we see in the screen is 3 circles, each for each approach. One for assumption-based, one for evidence-based, and one for stochastic. The joint points between assumption-based and evidence-based is that they are both tractable and easy to explain, and we work with something that intuitively it's really easy, basically. And on the other hand, the joint points of evidence-based and stochastic approach is that they both do the same thing. They capture sequences of returns risk, and they produce a very large number of scenarios. The fundamental difference is the one approach does it using historical data, the other approach does it using probabilistic data, but they do the same thing. In fact, they are more similar than different. The main criticism of the stochastic approach is that it is only good as the inputs, and the main criticism of the evidenced approach is that past performance is not a guarantee of future performance. But that means, what if we do a stochastic approach that eliminates the problem that, past performance is not a guarantee of future performance because we will be producing unique sequences of returns. But then we have the problem that the approach is only good as the inputs. But who can provide good inputs? I got asked that question in the chat previously. The answer is yes. We can rely on a stochastic modeling approach using 100 years worth of historical data as the backbone. So the capital market assumptions that we feed in the model should rely on 100 years worth of historical evidence-based backbone. And let's see an example of how we can do that. we're back to the John Doe example with 1 million UK portfolio. We start at asset class level. We have the expected return and the volatility for each asset class, taking into account the whole 100 years worth of historical data. We then compute the portfolio return using the asset allocation and the returns of the asset classes. We then compute the correlations of the asset classes within the portfolio. And finally, we compute the portfolio volatility using the correlations, the asset allocation, the volatility of the asset classes, and Markovitch formula. And now we have two estimates for the portfolio itself, and we can run Monte Carlo based on these capital market assumptions that take into account all of the historical data. What you see in the screen is a comparison between the evidence-based approach and the Monte Carlo on exactly that plan there, 1 million 50/50 UK portfolio, spending £55,000 and so on. The success rate using evidence-based approach has been 76%. In other words, 76 out of 100 historical scenarios, the plan would have been sustainable, would not have run out of money. And then we look at the Monte Carlo approach and we see that it's very close. And this is exactly what we expected, because what we're doing here is we're using evidence-based approach to produce unique sequences of returns within the historical spectrum. Of course, there will be outliers, but we are tackling the problem of observed sequences of returns. So the result should be very close to the historical, because after all, we are driving the model based on evidence-based data. There will not be identical, there will be differences, of course, but the idea is that the results should be really close and the one should validate the other. And then on the other hand, we see that the legacy amounts show the opposite story. Even though the success rate in Monte Carlo is lower than the success rate in evidence-based, the legacy amount in Monte Carlo approach is higher than the legacy amount in the evidence-based approach. And this is not a glitch, ladies and gentlemen, because what has happened here is there have been scenarios better than the best historical and scenarios worse than the worst historical in this example. And as a result, all that picture tells you is, yes, there were less sustainable scenarios with the Monte Carlo approach, but for the scenarios that have been sustainable, they ended up with a higher legacy amount. This is all this picture says. And I think we can drop the next question here, Lee, if you would like to.
Yeah, okay. The next poll, yeah. So it's a starting point, isn't it? So which approach should be used at the starting point? So again, as many people as we can to get involved, that will be amazing. Where do you see the results on this one? What would you like to see? You can't say?
I can't say.
You don't want to say, or you can't say? It's a big difference.
I don't want to say yet. This is a tricky one, Lee. What is your view, though? What do you believe people will reply?
Well, it's hard for me to say now because I can see the results flashing up in front of my eyes, right? But I quite like the stochastic approach. I think it's and the evidence base. So I think the combination of all of them is where it needs to be, right?
Correct. I have one item that makes me particularly happy. We went from one person using stochastic
100%.
to 7 people using it as a starting point now, which is really great stuff.
So we've had less people participate on this. So if we can have a couple more, it'd be amazing. About half the room has casted their vote, if you like. But no, you're absolutely right. Where we started with one person, we're now sitting at 8 people that have said that, you know, this is the right approach. So that's really good.
Okay.
So there you have the results.
Brilliant. So about 41% says assumption-based, 30% says evidence-based, and 30% also says stochastic. And the answer is none. I don't know. There isn't a starting point. Each approach is different and can be used differently based on your client. And with that, I want to go to the next slide, which is the following. We can start by using assumption-based approach as a back of the envelope plan. We create the first plan there and we save that. And we use this as a concept familiarization technique with our clients, educating the client. And the reason for that is, once you eliminate the uncertainty, the variability of returns and inflation, you can focus precisely on how are capital gains taxed, why is the tax X. So you can focus precisely on demonstrating the theory behind. So things like basic cash flow, impact of compounding, returns and inflation, tax wrappers, different tax wrappers treatment, withdrawals. Use the straight line projection, assumption-based approach, as a back of the envelope tool to explain concepts like that when needed. Then we go to the evidence-based approach, which essentially is where is the starting point of the planning. We don't know what is going to happen. We don't. But what we do is we can approximate what has happened. And this is using evidence-based approach. So let's start by creating a plan that has been sustainable historically, using the evidence-based approach as a backbone. We can see if the plan has not been sustainable. We can discuss this with the client, see if they feel comfortable. At the end of the day, they should take the responsibility and be okay with a 70% success rate or 80% or 90%. So let's make adjustments to the plan to reflect all of this and make it sustainable to the extent that the client feels comfortable with it. And it can also be used to further motivate discussions around educational purposes. Again, impact of diversification, expected returns and volatility for different asset classes, the impact of rebalancing. I'm going to say it, if you do periodic rebalancing, quarterly rebalancing, or annual rebalancing, you need to review that. Sorry. There are so many approaches there, and the impact can be measured using historical data. In timeline, we use an evidence-based approach, which is tolerance. We have a 10% drift. And then you can stress test the impact of withdrawal order and deliver all this as education. That's the part where you have a plan that has been sustainable historically. Then use a combination of evidence-based and stochastic modeling to provide different levels of reinsurance when needed. So let's assume we get asked, we don't want to rely on historical data. We want to rely on probabilistic data. That's okay. We can then use a stochastic approach, but equip it with 100 years worth of evidence-based backbone. Then we may say, I don't want to rely on 100 years worth of analysis because it includes extreme scenarios like world wars, recessions. I want something more recent, maybe take into account the last 20 years. Again, you can do that. You can do a historical analysis by taking into account the last 20 years only. And equivalently, you can produce a probabilistic approach, the stochastic modeling, that also takes into account it's driven by the last 20 years. And many other questions that what happens if I want to overstate only the downside, but not the upside? You can do that. You can use the historical data and then equip the downside using more extreme scenarios that have been produced from a stochastic modeling approach, and so on and so forth. Just a second of silence for the objectives, and then we can move on to the last slide, which I'm going to talk the less about. How can timeline help? Well, we do all of that. We have straight line projection, evidence-based, and stochastic modeling. But the most amazing part, in my opinion, is that we have functionalities that allow for easy transition. You can start with the back of envelope straight line projection, move on to the evidence-based, have them side by side and compare them and show the impact of each approach. And then you can create customizable reports that include parts of them or all of them. And with that, that would be it. Happy to take any questions. And if you have any questions about timeline, please feel free to contact Kate Phillips, my amazing colleague who evidently speaks better English than me and can help you in a better way. So that would be it from my side.
Thank you, Georgios. I think it's fair to say, and hopefully everyone will agree on the webinar, that the one slide that kind of summarises the different approaches and kind of everything that takes into consideration, from rebalancing to tax wrappers to withdrawal orders to events that happens in a client's life that you don't know the answer to or you can't predict. And I think what we're trying to do here in quick summary is just to say what this does is two things. One is that it really educates the client on what goes into cash flow planning. It really demonstrates the value that paraplanners and IFAs have when they're trying to make sure that they're making the right decisions for clients. And I think what it helps to do is then absolutely put that in a robust way that means that actually when you're sitting in front of a client, you can really demonstrate the value that you are bringing into that conversation with a client. Now, I'm not suggesting that you use these slides with clients. Timeline has a great way to be able to put all of that detail into a very clean, friendly document that is easily explainable to a client, and I think helps demonstrate. And I would argue that it kind of provides an advisor's playground, if I could use that phrase, because what you can actually do is go in, you can build duplicate scenarios with a client, and it's really easy with buttons just to say, okay, Mr. Client, do you want to have 10,000 or 15,000? Should we plug in the holiday as well? Let's run all of these scenarios. Let's take your wildest dreams and work from there, and then think about what we need to be doing. So it kind of allows you to have a really open 360 holistic conversation about the way that we view cash flow planning, and then hopefully bring it to value to life a bit more. And just to say, I know Lee's put it on the screen, so I won't steal your thunder.
No, go ahead.
Yeah, we've got an event coming up in collaboration with the Financial Planning Club on Tuesday the 29th. It is due to be at our offices, as you can see there on Greychurch Street, but actually at the moment, due to popular demand, we may move next door just to accommodate more bums on seats, but we will indeed keep everybody informed. What we're actually going to do, Georgios is going to be with us, but we're actually going to be utilising the tech that day. So we're going to take all of the detail that we've shared today, all of the underpinning, and then we're going to recap that again, but equally for those that weren't on today's webinar. But what we're actually going to do then is take what we're talking about and pop it into the technology. For those of you on this call, to see how easy that is to do, and therefore making more robust scenarios. I know that we've got a couple of questions there, Georgios, so I'll hand back to you. I know that Becky talks about cash calc and using de facto's growth assumptions based on the risk level of the investment. She feels this is simplistic by using the de facto average growth levels because they're automatically smoothing the volatility. So that's an interesting observation. Georgios, I'm not sure if you've got anything to add there.
Yeah, I think if you're going to use growth assumptions, this is fine, but it shouldn't be done in an assumption-based approach, but rather it should be done on a stochastic modeling framework. It should be equipped with a volatility. Otherwise, if there is no uncertainty involved, you're back to straight line projection, and this is really not suitable for planning.
Perfect.
Also, guys and girls, when you leave the webinar, there will be a feedback form as well. Feedback is incredibly important to us, so please do cast your feedback. Amanda's put a link in there for you to complete if you'd like to come along to the face-to-face event with Timeline on Tuesday, the 29th of April. It'll be great to see some of you there in person. Kate, you've had a message on the Q&A. I don't know if you can see the Q&A, yeah?
Yeah, Becky, I'm sure that we can absolutely put something together and we can work through that with you. Mike, not an issue either. Lucky you.
Yeah, and Rachel's asked some questions around the planning tools as well. So on any of your questions as well, when you actually complete the feedback form, if you've got any particular questions that you want answering, please put them on there. Kate and Georgios will see those as well, and they'll be able to respond to you personally if you want to know a little bit more about Timeline or the planning tools or what some training, whatever it may be. If you just write a little note on the feedback form, either Kate or somebody in the team will get in contact and let you know how they can help. As always, you can book a call in with the club as well. We work very collaboratively with Timeline, so we can always have a conversation and put both of you together. Not a problem at all. But we've done it. We've done it within the hour as well. We've had plenty of questions, so please do use the last 5 minutes. If you have any further questions, please fire away. And we'll do.
I see a couple of they're asking for Kate's details. So Kate, would you like to share your details?
Yep, just doing that now. Rachel, I've just seen your question as well. Apologies, I was in the other Q&A session, so I'll just answer that as well.
There's so many different areas that you got to keep an eye on, isn't there?
I love the comment. Past performance is all we have. That is very great from saying that.
Oh, perfect. Well, thanks, Amanda. She's done this before, clearly. She's a whiz. But yeah, I've popped my email address in. Happy Friday, everyone.
Well, Mike, it looks like you're not coming to the event then. He works from Barcelona. I feel like we could do an event on tour, couldn't we, Kate?
I think so. I think so. And Lee, if you don't mind, it'd be great to hear from the audience whether or not they felt it was too much detail. We tried to balance it out with making sure that we provided the right level of detail, but would be keen to understand if that was interesting and whether or not we need to consider more or less.
More or less, or was it good as it was? It'd be good to get your feedback on that. So if you just pop a more or less in the chat function, that would be amazing. But if you need more, you need to come and see us in London, don't you, on the 29th? Because that's where you're going to get.
Absolutely.
Good as it was, fantastic. No, it was great, fantastic. It's a hard one to judge, isn't it? Whether you're going to go into too much detail, not enough, but it looks like you sat bang in the middle, which is perfect. So last couple of minutes, for those that are hanging around with us for the full hour, if you've got any questions, please do fire away. If not, complete the feedback form. Any final questions on there, Kate will get a copy of it and she'll reach out to you personally.
I will indeed.
Yep. Fantastic. Amazing. What I'll do, I'll stop the recording now.